policy priorities clearly have to shift towards austerity. As long as fiscal sustainability is taken for granted and can be taken for granted, you can use it to overcome problems by stimulative measures. If it's in doubt, you have to basically switch to austerity mode. There's no alternative to it. Well, ladies and gentlemen, it's a pleasure to be here. I took the opportunity to accept the invitation of the Foreign Policy Association. I see you're close to your 100th anniversary, so it's a very strong tradition. I took the chance that we just came back from Washington, D.C., where we had the annual IMF World Bank meetings. I'm the German governor on the IMF, and unfortunately, due to ill health, our minister could not be in around this time. So, as you can imagine, it was a busy weekend. And in passing through, I decided to give a few talks here on European affairs. I understand that the association's objective is for inspiring Americans to learn more about the world, and I'd be quite happy to make a modest contribution to that. Now, the circumstance for a central banker to speak to such an audience after what is the 4th year of the financial crisis are pretty obvious. If we speak nowadays, we have to talk to the general public about the crisis. We have to talk about how the crisis evolved, how we dealt with the crisis, but that would be a lesson in history. What is more important is to basically focus on the way forward and the lessons that have to be learned within the 4th year of the crisis. As was mentioned, very often there is a temptation to say the crisis is now behind us once the steepest drop is behind us. But I think it would be the wrong message. We're in year 4 of the crisis and not in year 1 after the crisis. So we have to focus solidly on what lessons to be learned. And I'm just going to contribute here some lessons from a European perspective. The European economy, after taking the steepest fall in post-war history, is now on what I would describe a stable path towards recovery. Also, the pace at which we are recovering is moderate, and there is still a serious degree of heterogeneity between European member states. The Greek crisis, which you probably all heard about, clearly demonstrated a smooth recovery in Europe cannot be taken as a given. It is not granted, but I'm confident that the dangers of sliding back into recession are increasingly negligible. Now, the two issues that are at the center of the European policy debate that I would like to talk about here are twofold. First, macroeconomic imbalances within the monetary union, and second, the role of fiscal policy for macroeconomic stability. Because at the core, the Greek sovereign debt crisis is a fiscal crisis, and it has major repercussions on the macroeconomy at the European level. So let me begin with the imbalances in EMU. Now, the public debate on imbalances in EMU focuses usually on current account positions of member states. It should not be confused with a debate that is now globally led on the imbalances on current accounts between different regions of the world, surplus countries like China or Germany, and deficit countries like the United States. But it has a link. Intra-EMU imbalances are not a globally relevant phenomenon because, as a whole, the currency area, the euro area, is relatively balanced. We have an almost balanced current account position with respect to the rest of the world. But within the European Union, there is some countries with persistent current account surpluses, like Germany, Austria, and the Netherlands. And there are some countries with persistent current account deficits, like Portugal, Spain, Greece, or Ireland. Having said that, it's not a new phenomenon. It has been there since the start of EMU. We have ignored it to a large degree since the start of EMU. But in principle, you could also make the point that theoretically, current account surpluses or deficits are not a bad thing in themselves. They reflect national savings or national borrowings. And just like for private agents, it is quite natural that at some point in your life you borrow money from others and later on repay. So the deficits or surpluses are not a bad thing in itself. Why it's relevant for most of the countries in Europe is not all countries are the same. For example, first, there's a set of countries with aging populations, like Germany, who initially have a situation where they save more than they invest. Declining domestic investment opportunities then lead to temporary current account surpluses. Aging societies usually are characterized by that. And there's another group of countries, catching up economies, who develop relatively rapidly. They invest more than they save. Many of the investment opportunities are financed by capital that's coming in from abroad. There is very little capital in these not-so-developed economies at the early stages of development, so a transitory current account deficit is nothing unusual. It kind of reflects the stages of different stages of development. The common feature is that current account surpluses or deficits are useful because they help to smooth consumptions over time, which is a useful proposition in economics. However, what is relevant is that the capital flows that I just alluded to into some of the countries, from countries with large savings to countries with high investment needs, are paid back at some point in time. The flow of capital in the euro area has increased strongly after the creation of the euro area. There are two reasons mainly for that. When the euro was started, exchange rate risk was eliminated within the euro area, so capital flows from Germany to France, Greece, and the other countries increased simply because of this reduced uncertainty. Second, countries' default risk at the same time were perceived as converging towards a relatively low level. At the period before the crisis, 2005, 2006, 2007, Greek government bonds traded a mere 10 basis points above German bonds. We have seen periods recently where that trading was at double-digit spreads relative to German bonds. So you can see what a landslide change these few years have brought, from 10 basis point to 10 percentage points of spreads. Now, there is one issue regarding current accounts that we know very well from theory. According to the reasoning of economic theory, intra-EMU capital flows should reverse once investments in deficit countries start to pay off. But in practice, the main problem with many of the capital flows into current account deficit countries, member states in the euro area, was that the capital that flew to this country was not always used wisely. It wasn't allocated efficiently. In Spain and Ireland, most of the capital inflows went into a real estate boom in these countries, which was recently sort of leading to a strong collapse in the housing markets in both of these countries. In Greece, the capital inflows funded high government deficits. And in Portugal, the capital inflows supported strong private consumption. This allocation basically spurred domestic demands. Wages increased more than productivity. Labor markets were pretty inflexible. This reduced competitiveness. The imports increased further. Exports went down as a result, and the current account deficits grew further. So rather than having a return on investment from capital inflows, the use of capital for consumption, for real estate funding, or for other purposes like funding high deficits did not lead to a return that would later reverse these flows, and the situation aggravated over time. Also, the imbalances have a domestic root. They also did have international repercussions. Because the euro area is a very well integrated financial market, so spillover effects in the monetary union as a whole occurred. And second, the debt crisis in the first half of this year was a clear case in point that we have to tackle the issue of current account imbalances within the euro area. Now, having recognized that we need to do something about the problem, the question is, what is it best that we need to do? My conclusions are, since the problems of imbalances in EMU have to be addressed, The major issue we need to discuss is it the surplus countries that need to act? Is it the deficit countries that need to act? Or is it both? The deeper causes of the underlying problems are domestic factors within the deficit countries. So, in my view, they have to act. They have to do three different things. First, countries like Portugal, Ireland, Greece, and Spain have to enhance competitiveness of their domestic companies by increasing productivity and keeping costs in check. They have to increase labor market flexibility, and they have to consolidate government budgets. In the end, this will reduce domestic absorption to a sustainable level. This may sound harsh, but it is inevitable for economies that have lived beyond their means. And I think that is the key message that we have to start giving. There are economies around the world that for a while, and maybe for some time, have lived beyond their means. Now, there are voices that say, well, this is a harsh adjustment program, so why can't we go on basically contributing to the problem by demanding that surplus countries should also do part of the adjustment or place the entire adjustment burden on the surplus countries? One argument goes, import demand from deficit countries has to increase. But I think it's wrong if you focus on the surplus countries. Surplus countries should, and I believe in that, actively boost domestic demand and consequently imports, or by using fiscal policy, they could use expansionary wage policies instead of allowing market forces to make the adjustment. But if a policy remedy is to go down these two roads, it does have major implications. And let me just briefly outline what those would be. First, claims to boost imports neglect the trade flows, are highly diversified. If you take current trade structures, what you can easily see is that, for example, an increase in German imports by 10% would only increase and improve the current account in Spain, Portugal, or Greece by a mere 0.25 percentage points. So the expectation that if Germany only were to raise its imports and stimulate its domestic demand, it would automatically lead to a lesser adjustment burden in the deficit countries is not warranted by the facts, unless we have major changes in the composition of exports and imports around the world relative to status quo. And these are long-term issues. This doesn't happen quickly. So I don't think it's partly a solution. It would help Ireland somewhat because a 10% increase in German imports would raise exports and the current account deficit in Ireland by 1 percentage point, so 4 times as much as in Spain or Greece or Portugal, but still that's only 1/10 of the initial impulse that we have in Germany that basically reaches these countries. What would happen is peripheral countries in Eastern Europe who are very strongly interconnected with their exports as part of German imports, they would gain more than the countries who would need it most. So it's not a practical solution. There's a second claim, what the surplus countries could do. I often hear that they could raise wages to support domestic demand and reduce competitiveness. Now, this neglects that, first of all, in Germany, wages are not a political control variable. They're not set by governments. They're negotiated freely between employers and unions representatives. So policy influence over the wage bargaining process is something that in Germany is not accepted at all as a political channel. Second, most studies show that the only effects or the main effects that an increase in wages would have would be concentrated on the domestic economy in which wages are adjusted, mainly taking the form of changes in the employment rate. So if Germany were to raise its wages, that would result in a change in the German employment rate, with the unemployment going up. It wouldn't really add to more adjustment at the global economy. It would simply create problems in the domestic economy. Finally, the claim to use fiscal policy to stimulate domestic demands and import neglects that basically public finances in the euro area are also strained. Germany's in an excessive deficit. to stimulate the budget, to use the budget further to stimulate the economy, would simply increase that excessive deficit. We have a high and rising debt level, north of 80% of GDP. So increasing that even further would not really be a confidence-inspiring fiscal move. And finally, there is a huge overhang in Germany in the area of unfunded liabilities, what we call as economists an implicit unfunded liability, if you look at the future entitlements that are promised by the government in the area of pensions, in the area of healthcare, and in the area of basically supplying for the needs of an aging society, and you compare those future payments with the future flows into these systems, taxes, contributions from pension systems, you can see that the difference between what was promised to be paid in the future and what will be the amounts of flows that go into these systems lead to a 270% of GDP unfunded liability. So basically this should tell you this is 2.7 years of output that future generations will see as a cost over the expenditure that are already determined by the entitlements that people have already achieved at this point in time. 270% of GDP, if you want to balance that, you could say current generations owe future generations 2.7 years of production. If you then consider that only 50% of the workforce is actually actively employed, a participation rate of 50%, you can double that number. If you want to balance these social security systems, health, pension, etc., you need 5.4 years of additional working lifetime to balance this system out if the only adjustment comes through the working age adjustment. And that is a very surprising result. Let me remind you of something which shows you the gravity of the situation, just as a sort of sidestep from my remarks, which are posted on the web and which you can look at. When the German health system, healthcare and pension system was introduced in 1850 by Bismarck, the official retirement age in Germany was 65, the same age that it was in 2000. 150 years later, nothing had changed on the retirement age in Germany. When Bismarck created the system, average life expectancy was 52 years. So the system was well balanced. Average life expectancy in 2010 is bordering onto 85 years. So it's 30 years in excess of the official retirement age. And it's moved from 52 to 85. The pension system and the retirement age did not at all reflect these fundamental changes in the quality of healthcare, in life expectancy, in the cost of healthcare. So we basically have a 150-year backlog on reforms that we need to embark on. In Germany, these reforms have been embarked on in 2004. And we've done some adjustment. The working life moved up from 65 to 67. We've been criticized very much by saying it should move to 69. Whilst you're at it, keep going. Or even better, index working life to the life expectancy of people. So the longer people live, the longer they have to work in order to keep a constant balance between the active life on the job and the retirement age to balance these systems. And these are processes that most of our countries will face. They're not yet addressed. And this is why, in my view, it is very important to talk about the role of fiscal policy in securing stability. I'm a central banker, and I can tell you, you cannot have stable money and stable prices if the fiscal trajectory, if in the fiscal space there is an underlying disequilibrium and there is a doubt that fiscal policy will be on a sustainable trajectory. If people fear that the promised entitlements they get from the government will not be backed up because the fiscal space is not on a sustainable trajectory, they will hugely discount these promises and they will take own provisions to replace government promises. And this is very much what we've seen in Germany. In Germany, the saving rate is around 13%. This saving rate of 13% shows that a lot of people are taking their future fate into their own hands and provide own savings of which they can live later on to substitute partly for government promises in the pension, healthcare, and the other systems. Now, that may be a second best solution. So we have to talk about how can we achieve a better situation in the fiscal space, and that's going to be the rest of what I will talk about. Now, in EMU, this issue that I just alluded to applies to most of the countries in the monetary union. If you look at German opinion polls, the thing that German people fear the most is old age poverty. And therefore, provisions for old age are at the forefront of determining the saving rate for many Germans. It's totally different in other countries where basically the saving rate has been close to zero for many years, where extraction of the rise in the property value of housing was used partly to fund current consumption. In our view, that's not a sustainable situation, and if something's not sustainable, it will change. And once it changes, it is very hard for policy to embark on policies that can perpetuate the current state rather than smooth out the transition to a new state of affairs. And I think this is partly what we're seeing as a result of this crisis. Now, let me go back to the European experience. The spring of 2010, the sovereign risk came to the fore, turning into a major downside risk for the European recovery. The fiscal problems in Greece and other member states turned into an imminent danger for the stability of the financial system and of EMU itself. In May, member states and the EU decided to implement far-reaching measures to support countries in question. Fiscal measures were justifiable, in my view, given the risk associated with inaction, but seriously, there is a strain from these measures to the foundations of EMU. You're probably all aware of the fact that in EMU, in the monetary union, fiscal policy is a national responsibility. There was a deliberate decision by European governments not to have a fiscal policy and fiscal responsibility at the level of the union. It was continued to be a matter of the national governments. But of course, the bailout of countries like Greece goes against this fundamental problem because it is a fiscal transfer from some sovereign countries to others. So the real question is, if this is shaking the foundations of what used to be the agreed collaborative system, how do we get back to a new long-term solution that basically takes into account the incentive structures that such wrong incentives could provide? Now, what we need to do in Europe is we need member states to restore public finances to a sustainable mode. The tasks in this context, in my view, are twofold. First, we need, in the current situation, a credible consolidation of government budgets. And second, we need a strengthening of the fiscal framework in EMU. Let me talk briefly about the consolidation that is needed. Greece and other member states have taken initial steps. It is important for them to maintain the momentum. Very often you hear arguments that such fiscal tightening might have negative effects on the real economy. But in my view, it doesn't speak against such action per se. In particular, since the sustainability of finances is questioned by financial markets. If that is the case, and we've seen that increase, policy priorities clearly have to shift towards austerity. As long as fiscal sustainability is taken for granted and can be taken for granted, you can use it to overcome problems by stimulative measures. If it's in doubt, you have to basically switch to austerity mode. There's no alternative to it. Moreover, in the longer term, immediate consolidation prevents negative spillovers from public finances on growth. In my view, a credible consolidation can serve as an anchor in the current uncertain environment, and this is why I think that the deficit countries like Greece, Portugal, Ireland, and Spain are doing the right thing. They're basically taking the measures to get their fiscal house in order, rather than relying on solidarity contribution from other member countries to help them bring their house in order. Of course, you all know about the SPV and the European mechanism, where solidarity contributions are part of the help that is currently being put in place, but this is a transitory measure. This is something to overcome the imminent crisis. It is not a long-term solution. And since it's not a long-term solution, we need to do the second thing that I talked about, namely to strengthen the fiscal framework. This is necessary to guarantee sustainable and sound public finances in the long run. The centerpiece of the European finances are what we call the rules of the Stability and Growth Pact. They've been decided upon with the start of EMU. The main provisions are that budget deficits in bad times should not exceed 3%. In good times, we should aim at surpluses or at a roughly balanced position, and that the level of debt to GDP should not exceed 60%. Actually, if you look, by now, most of the countries exceed that debt level, with many of them going towards 100% debt to GDP ratio rather than the 60% that are in the pact. So we clearly need to change our fiscal behavior. The rules of the Stability and Growth Pact, in my view, in general are appropriate. The thing we need to focus on is to improve compliance with these rules. It's not useful if you have a good set of rules if nobody complies with them. So compliance needs to be strengthened. Any violations in the European Stability and Growth Framework have the weakness that the decision on what action to be taken are basically political decisions. They're taken by the governments in question or by their peers. I think this adds an undesirable degree of flexibility to the rules. I think it, in my view, would be much better to install a system of sanctions that is much more on autopilot rather than national discretionary decisions by governments involved. And at the same time, what we've seen is the deficit focus was too strong. We need to focus on national debt levels in addition to deficits. Now, there are a number of adjustments, I think, that we will see, but still, I think the adjustment in fiscal behavior will not be sufficient to safeguard against macroeconomic stability, and this is why the Europeans are discussing a system of macroeconomic surveillance that will be put into place. I don't want to go, given the time constraints I have, too much into the details here, but I think it's fair to say, in coming close to the end of my talk, that what we need in Europe is not different rules, but more effective rules for crisis management. I think the relevant propositions have to be designed in a way that distortions to incentives will play a role in the future to a degree that is as small as possible. So distortions of incentives for wrong fiscal behavior have to really be countered very strongly, and we need to get that in place. In this context, I talked about the no bailout clause that we had in Europe. It didn't hold. It needs to be reinvigorated. And one way to do that is basically to impose fiscal discipline and basically to make use of financial markets in imposing this fiscal discipline. Also, for the system that we need to design for the future, private investors have to bear and internalize some of the risk of buying government assets which they think are worth the price. Just to take an example, it was mentioned before, we do some work in the Financial Stability Board to deal with the banking problems. And the clear mandate that we've given to all the committees is look at bail-ins rather than bailouts for the future. Bailouts means you put taxpayers' money at risk to solve problems in the private sector. European taxpayers have put more than 25% of GDP of the European nations at risk in solving the financial crisis. I can tell you they will not do it again. And this is why it's important that one of the lessons from this crisis is that we align future incentives and responsibilities of investors such that the money on the line is that of the investor and not that of the taxpayer. And we need to get to that for the banking resolution regimes that we're designing, and I think we need similar systems also for bailing in private debt holders that hold government debt and not just bank debt. It's the same story, it's the same instrument, it has to be the same remedy. So we need to work on a framework for orderly restructuring of sovereign debt in the future. The current framework is not geared for that, so it will not play a role in the current crisis resolution, but for future crisis resolution, we need to have a framework where that dimension at least plays a role. A new resolution regime also with respect to sovereigns and not just with respect to corporates and banks. Financial support, basically in the future, should only be granted if there is a danger of contagion, and it should be the ultimate resort that we should go to. Also, we need much stronger conditionality in fiscal policy in Europe than we've seen in the past. So in concluding, I understand you want to also have a debate, and that usually a lecture like this profits from the debate because it's more interactive. Let me just conclude on the three main points I tried to bring across. First, macro imbalances in the euro area. First of all, they have to be tackled. In my view, it's deficit countries that need to undertake the major structural reforms to move. Additional measures by surplus countries can help, but they will do little to ease the adjustment burden on deficit countries. And finally, I hear that a lot in international meetings, Germany and China are very often compared as both surplus countries, and therefore we get the same questions for adjustments. That's a total misconception of the situation in Germany and in China. Germany has a current account surplus because we have millions of successful small to medium-sized enterprises which are competing at a world level. China has a current account surplus because they have an exchange rate which is manipulated by the authorities. If we want to get to the right remedies, we have to see that if the underlying causes are different, the remedies cannot be the same. So yes, let's have a serious discussion with China on the exchange rate, and let's take into account that Germany is successful in the world economy because we have a good industry, good products, high technical standards and skills in the economy, and a level of technical engineering expertise that has been part of why German products are successful abroad. Let's acknowledge that, and let's talk about the remedies, then taking into account these different behaviors. Finally, on fiscal policy, the most urgent talks for national governments is to consolidate their budget. I wouldn't necessarily limit this to EMU. I would say it's a general global phenomenon. If fiscal authority reaches the limit of what it can do, consolidation moves to the forefront of what is needed. And I think that's a story that holds as much for other constituencies as it holds for the EMU, but being a central banker, I of course only talk about EMU. Second, it's not enough to just tighten the budget. You also have to put a fiscal framework in place that strengthens the resilience of future fiscal expenditure and therefore gives the incentive for proper fiscal behavior into the future. The relevant propositions in Europe will be worked upon by the President of the European Council, Herman van Rompuy. He will make suggestions along these lines. They're due to come out soon. You can hear some rumors already. What is in the pipeline, of course, I didn't expect it any different. There are some that are fighting a more stringent set of rules and others that are insistent on such rules. We will see the final proposal in a few weeks' time, so if you invite me again in some time in the future, I may be able to comment on these suggestions, but at this point in time, they're not yet out, so let's wait with what is on the table. Thank you for your attention, and I guess we'll open up for questions.